President, you mentioned the ups and downs in the stock market. You said it'll go up, it'll go down. But do you and your tariff policies right now bear any responsibility for the turmoil we're seeing this week?
Biden gave us a horrible economy. He gave us horrible inflation. And I think the market was going to go very, very bad. If anything, I have a lot of very smart people, friends of mine and great businessmen. They're now investing because of what I'm doing. Because long term, what I'm doing is making our country strong again.
What's up, everyone? It's Economics here. Now, if you've been paying attention to the market for the past few weeks, you already know the entire market is in the red. And as of today, the S&P 500 is down about 10% from its peak last year. But this is all due to a number of factors such as political uncertainty, trade tensions, global slowdown, conflicts around the world, and just overall the entire media panicking. But the truth is, if you're an experienced investor or you just have some general knowledge of economics, you already know recessions and economic downturns like this happen all the time. It's happened numerous times throughout history. We've always seen history repeat itself, and time again, it's always been the same outcome. Now, I'm not going to say past performance predicts future outcome, but most of the time, especially when there is an economic downturn, that is when we have to capitalize on these opportunities. We have to be like sharks smelling the blood in the sea of red. Now, if you've been paying attention to the media, they're always going to try to tell you, oh, the world is ending, the world is ending. All these old heads or retarded analysts are going to try to instill fear in you. But the truth is, time and time again, we've seen throughout history that after each economic downturn, the market has always recovered and performed significantly better. And that is why it is important for us to create our individual plan, do your own research, and manage your own risk according to your risk tolerance. But truthfully, if the world is really going to end, I probably wouldn't even care about how much losses I take in my portfolio anyways. I'd probably be looking for a nuclear shelter, and you guys wouldn't even be watching this whole video. If you take a look at the historical data, back in 2008 during the housing market crisis, the S&P 500 crashed nearly 50%. And for those people who decided to capitalize on this opportunity to buying at the bottom, they saw massive gains in returns as the S&P 500 recovered and as the market recovered. Same thing with the 2020 COVID dip. Now, I'm not going to say COVID-19 was a good era because a lot of people lost their lives and the whole world was on shutdown. But in terms of the market, the buyers who decided to buy down on the dip, they saw massive returns as the market rebounded. And the data is very clear. Over the last century, the market averaged 7 to 10% return after each inflation. This dip, well, I'm not going to say it's any different than that time, but you guys can be your own judge. Personally, I'm going to double down on my investment in this dip. It is certainly not the end, and this is why I think it is your chance to get in on this before the gate closes. Now, before we dive deep into how you can capitalize on this opportunity, let's first go over why the market is in the red in the first place. There are three main factors contributing to this economic downturn, and those three are tariffs, economic slowdown, and monetary policy tightening. Now, let's dive deep into each one of these factors and why it's contributing to this economic downturn. Starting off with tariffs. Now, it is no secret that the US and China have been at each other's throats for years now with the trade war. And now with Trump back in office, the tensions have been rising ever more, even with America's own allies. And these geopolitical tensions can be further amplified by the rising concerns that China will eventually go to war with Taiwan, the conflict in the Middle East, and the current ongoing conflict in Ukraine. So why are these tariffs here in the first place? Well, to simply put it, the US is at a significant trade deficit with China, and it has been for a long time. And tariffs are often a justified way to address this imbalance by encouraging exports and discouraging imports. In this way, it boosts domestic production and encourages domestic consumers to purchase more domestic products. But this often comes at a price because oftentimes big dogs like China, they're not going to let that slide. They will often retaliate with their own tariffs, and in this case, they retaliate with a tariff on US farmer goods. And in Mexico's case, tariffs are used as a way to combat the import of drugs and encourage the Mexican government to take action. Now, moving on to economic downturn. Now, it is no surprise to us that the current economy is at a slow downturn. The recent data shows that GDP growth has slowed to just 1.5% in the last quarter, down from 3% a year ago. and unemployment has crept up to 5%. Consumer confidence is at its all-time low in the last 2 years, and these numbers suggest the economy might be hitting a rough patch. Investors are starting to worry that businesses and consumers are starting to tighten their belt, further dragging down stock prices with them. The Federal Reserve is always playing a big role. To fight inflation, which is still hovering around 4%, the Fed has raised interest rates 3 times in the past 6 months. And higher interest rates means it costs more to borrow money. Whether you're a consumer or you're a company expanding a factory or you're a family planning to buy a home, this can significantly slow down the spending and investment, and investors are nervous that further increase of interest rate can further downturn the economy. And this fear is pushing investors to start panic selling in this economic downturn. So these 3 factors, tariffs, economic slowdown, and increased pressure on monetary policies, have created a perfect storm. Investors are starting to hit the panic sell button, especially on stocks tied to economic cycles like tech and consumer goods. Now picture it like a crowded theater. When everyone yells fire, everyone's starting to rush for the exit at once, and this further increases selling pressure. The selling pressure drives the stock prices down even further, and that's when we see the sea of red. This uncertainty has also juiced up market volatility. The fear index has spiked up to its highest in over a year. So what does this all mean to you as an investor? Well, you got 3 options: buy more, sell, or you can hold. And if you got stocks, chances are that portfolio probably took a huge hit, and I can certainly understand it is not a good sight to see yet. It is absolutely stressful to even think about it. But here's the thing, market downturns are a perfectly healthy part of the economy, and it happens all the time. And the key is to stay calm, stick to your plan, and always do not panic sell because you hear what the media is telling you or these retarded analysts are coming up with brand new crazy theories. So looking ahead, the crystal ball isn't exactly clear. If we continue to see political tensions rise or market volatility, we might see more and more of these red days and more of a bear market. But if there is an ease up of political tensions or the Fed's hint at easing up on the interest rate, we could see an increase in the market spirits pretty fast. Here's the silver lining. History always tells us that the market eventually bounces back, and it's all about riding out this red storm and having a long-term view. So, in my personal opinion, if you're allocating money that you don't need in the near future, it is best advice that you ride out this wave. So to sum it all up, the market is in the red because of economic slowdown, fear of political tensions, and the increased spike on the interest rates. These have all spooked investors and started to make them panic sell. It is a very bumpy ride ahead of us, but I promise you, after every storm, there is going to be a rainbow. And as always, guys, check your risk level, stay informed, and adjust your plan accordingly. Especially you have to keep your vision on the long game. And if you're feeling unsure, chatting with a financial advisor might be the best solution for you. Like I said in the beginning of the video, I'm not a personal financial advisor. This stuff I say in this video is mainly based upon my opinion. I could be wrong. And that's it for today. Hope you guys enjoyed all the valuable information I brought to you guys. If you're new to the channel, please make sure to go down there, hit that subscribe button for me. I would really appreciate it. As a small YouTuber starting out, it would tremendously help me out a lot. If you guys want to check out my main channel, my entertainment channel, link it in the description below. And drop a comment down below of what your opinion on the future of the market is at its current stage. And as always, make sure you guys stay safe out there. So as always, guys, stay informed. Check your own risk tolerance levels. Make sure you adjust to your own political